It seems like almost nothing can get in the way of Bitcoin's epic run. For the first time ever, the cryptocurrency has pushed past $7,000, a run that has, so far, proven a number of heavyweight naysayers wrong.
We have these criteria for determining what a bubble is. In other words, we take these criteria. I won't get into them because it'll probably take too long. But these criteria, and we just define a bubble based on those criteria. Bitcoin is a bubble.
I think this is Enron in the making.
That's because it's used for illicit purposes, and so it's just not a real thing, and eventually it'll be the emperor without clothes.
The price of Bitcoin plunged when the CEO of banking giant JP Morgan, Jamie Dimon, made those comments back in September. But it was also reeling at the time from a crackdown on exchanges in China, one of the largest cryptocurrency markets in the world. And even though China hasn't changed its mind, Bitcoin has come roaring back. Institutional investors like pension funds and mutual funds can now indirectly invest in Bitcoin through futures trading. That announcement earlier this week helped push the total global value of Bitcoin to more than $121 billion. Many call Bitcoin one of the biggest market bubbles since Holland's tulip mania back in the early 1600s. But here's the flip side to that coin. Some see the digital currency as the future of money and a threat to the entire banking system as we know it. And if those predictions come to pass, we may only be scratching the surface of Bitcoin's future value. For more on what's driving Bitcoin and why it's such a roller coaster of a ride, we're joined by Robert Sloimer. He's the managing director of technical strategy at Fundstrat Global Advisors. I want to start with a quote by the CEO of Credit Suisse this morning, saying that Bitcoin is, in his words, the very definition of a bubble. What do you say to that?
Well, it's interesting, Peter. Bubbles are things that are very difficult to identify when you're in them. If you think about the past bubbles that we were aware of, that we know of, technology, think about the materials bubble in the late 80s. At that point, I think you could argue that most people, most investors were involved in the asset at the time when it exploded. We all talk about Bitcoin, and it has certainly had a very strong run. But I don't think at this point most people are investing in the cryptocurrency at this point. So we at Fundstrat don't believe Bitcoin is a bubble yet. We think it's probably going to get there at some point, but we think it's probably a few years off.
But I mean, you can go back to a time when I think it cost 2 Bitcoin to buy a pizza at its very beginning, and now a single Bitcoin is worth $7,000. Like, the run has been incredible. What is it you think that's fueling it if it's not just a speculative bubble?
Well, I think there's a couple of things. Let's look at the global excess liquidity driven by central bank balance sheet expansion, right? A lot of capital has been looking for a place to go. So risky assets in general, and stocks to a certain degree represent that, have been driven higher by capital finding a home. I think Bitcoin is one of those. The other side of it is when you think about what Bitcoin is, it's arguably a store of value due to its limited supply. And so it can be thought of as digital gold or a proxy for gold. And the other side is you can think of it as a currency. So when you think about the size of the gold market and the amount of gold that's in circulation, Bitcoin is just a fraction of that at this point. And then when you think about Bitcoin as a currency that we can transact in a secure way, in a decentralized way, I think Bitcoin is something like 3% of US dollars in circulation. So if it's going to be a bubble, and it certainly has risen a long way, and it seems like it's getting into sort of crazy man land. But I don't think it's reached the levels where it's actually at the point where it's going to break down. We think that capital, particularly institutions with the announcement of the CME, are going to incrementally be moving into the Bitcoin market, and that's likely to last for a very long time. We still think there's more to go.
I don't want to get too conspiratorial here, but why do you think, we played those clips off the top. Guys like Jamie Dimon, big institutional sort of money guys, are so against this. Why do you think they're so skeptical about Bitcoin and its value?
Well, I think part of it is that the technology of blockchain, particularly when it's not held in private hands like a bank and it's more decentralized the way Bitcoin is, it to a certain degree is a threat to the existing financial system like the banks. So I think guys like Jamie Dimon and other bankers would like to control that currency, or at least have the blockchain technology held within the bank. But imagine having 30 or 50 developers in your bank trying to improve that cryptocurrency or that blockchain. compared to thousands of developers globally improving it. So I think the odds are stacked against the private blockchains versus the public blockchains.
So then you get to the point where, is it at a point where sort of individual, just regular investors, people watching this show, should be going out and buying Bitcoin? Because I think a lot of them still look at it, they don't even know how to buy it in the first place.
Right. Well, that's a great question. I think given the volatility, I'll give you a couple of points. If you think about what happened to gold in the early 70s when the dollar came off the gold standard, gold was incredibly volatile, north of 50% volatility ranges. And I think until you find that price stability, gold sort of tracked the same type of thing until we got into the 80s and 90s. Now, for Bitcoin, I don't think this is something that we're going to be putting in widows and orphans portfolios. It's a very volatile asset class. It's not appropriate for lots of people. But if you think of your overall investment in assets in general, whether it's fixed income or equities or hard assets, then I think as a fraction of a broader portfolio, as something that's likely to be adopted longer term, I think it does make sense. So think of it in terms of 1 to 2% rather than having 30 to 40%.
Right. Good advice all around, Robert. Thanks for making the time. Robert Slimers, the Managing Director of Technical Strategy at Fundstrat Global Advisors.